Welcome to Subramani. We are at 82,500 Sensex, or about 25,100 on the Nifty. And one question which keeps coming up and people keep asking is it time to sell shares? Of course, it is a good time to sell shares because it is not a market where you are going to look back in 2027 and say, oh my God, I wish I had not sold. Of course, some of the shares which you sell will go up further up, and some of the shares which you sell may have actually gone further down. So this is a good market not to sell but to switch. What I mean is, right from my first day of investing, I have never sold shares to do something. I have only sold shares to buy something else, which means I have never sold, I have only switched. Do I have bad switches and good switches? Of course I have. Do I have regrets? I have none. I bought Infosys at 300 and in 45 days sold it at 750 rupees. Bad deal? No, not a bad deal, a good deal. I bought HDFC Bank at 440 and I am still holding. I have sold very little. Then the merger with HDFC Limited happened. I got more shares of HDFC Bank. Last 3-4 years it has done nothing. Do I have any regrets? No. There was a 7-year bearish market in Reliance, out of which I participated in the first 2 years and then sold off and then bought it back again. That was luck. When the Jio launch was happening, I said this can't be too bad, and before those big deals happened with those big investors, I bought, and then of course it has done very well. So sometimes you sell and benefit, sometimes you keep and benefit. So I bought Hero Honda at 40. I must have sold at 2,500 after split and bonus. After that it perhaps it of course became Hero Motors, and then it went up even further, right? So some of these things will happen, but when you sell, you switch. So what can you do now? Let us say you have bought many shares which have done very well. Let me name them. You bought ONGC, NTPC, Indian Oil, Bharat Petroleum, Tata Power, and maybe some more power companies, right? All energy companies. So what you can do is sell all your energy companies and put it into an energy fund. Similarly, if you have bought many PSU banks and NBFCs and the finance related companies, could be a company which is offering depository services, could be broking, could be insurance, could be mutual fund, you could sell them one by one and put into a NBFC or a BFSI fund. What happens by this is you reduce the size of your portfolio. Like I was just checking out, I have some 14 energy stocks and all of them are sitting on 4x to 15x in case of Tata Power. All the others are sitting on 3x, 4x. Even Coal India from 117 to 500 is almost 4x, right? So these kind of things will happen. So what am I doing by doing this is to reduce the standard deviation in my portfolio and to reduce the size of my portfolio. My portfolio from 14 will become 1 when I have one energy fund. My portfolio from 6 or 7 NBFCs and banks and etc. will become 1 by putting into an NBFC fund, BFSI fund. By this, what happens is you shift the thinking from yourself to the fund manager. Not a very smart thing to do when you, especially when you meet some of the fund managers, you keep wondering, is my money safe here? But you choose good fund managers and you choose some funds which are specific to the areas in which you are. By doing this slowly over a period of time, you may move to 4-5 ETFs and 4-5 mutual funds, and maybe you're left with 5-6 shares, some shares which you don't want to sell, or you say, no, I think I know this company well, why would I pay fund management charges for holding these companies, right? Why would I pay fund management charges for holding a Reliance, HUL, Cholamandalam and HDFC Bank, right? I don't need to. These are shares in my portfolio and I have done better than most fund managers during holding this, right? So I will stick to this. So both the strategies can be right. It is also a good time to be shifting from a lower quality portfolio to a upper quality portfolio. You have some shares which are recently IPOs which got listed at 70 and or rather IPO'd at 70 and now at 400, or IPO'd at 200 and now at 3000, and believe me, there are such shares. Maybe these are small cap, maybe those kind of companies. So in those cases, you say, okay, I know this has gone from 400 to 3000. I also know it will go from 3000 to 16,000 if I believe some of the TV channels. But I am very happy with my ride from 400 to 3000, right? I am thrilled with it. So for example, I bought MRF at 800, sold at 69,000. And then saw it doubling to 1,40,000. But I bought Vent at 26 and I'm still holding on. The price is 16,000. I'm not sold, right? So some of these things you hold, some of these things you sell. Sometimes you make a profit, sometimes you make a loss, sometimes you do a switch which is not very sensible. But you keep doing those things, and it's a good time to be improving the quality of your portfolio. So two things you can do. One is move from a lower quality portfolio, a small cap or a mid cap where you are not sure whether the quality of management is good, to a company which will grow but not at the same pace at which the smaller company could grow, but definitely at a lesser standard deviation. So you shift your portfolio from a lower quality to a higher quality, and also asset classes. For the last maybe 2 years or 3 years on a SIP and on a one-time investment, my returns in a gilt fund are between 16 and 13%, right? I'm not naming the fund house may not like it, but I have got good returns. That fund house never sold it as an SIP fund, so I'm not talking about that fund house. But I have made money doing an SIP in a gilt fund and getting 13% return. Of course, my lump sum has got 16%. That is at a time when interest rates are likely to only further go down. So maybe at 18-19%, I might just sell off and put that money somewhere else, right? So you could be selling a low quality equity, buying high quality equity. You could be selling some high quality equity and buying gold. You could be selling part of your equity portfolio and buying debt, or you could be selling a lot of this and buying real estate because you need a real estate, right? You are staying in a 3 BHK, your parents are likely to move in with you, you want a 4 BHK, so you are making that move. So some of these asset switches, some on quality and some on a different asset class, right? This is a very good time to be doing that. If you have bought something which was at 60 PE, which you thought was high, but now is at 118 PE, I'm sure it is time to get rid of it, because the price of a share going up should be because of EPS and PE. I'm not saying PE re-rating is bad, but only PE re-rating and no increase in EPS is a sure case that when the market falls, that share will fall faster. Having said that, also understand that some MNCs quote here at 120 PE and at a PE of 5 in their parent company, in the parent country. Right, so if a parent country is at 5 PE and this is at 120 PE, when the parent needs money, it's fairly obvious which share they will sell. Will they sell 5%, 2%, 1%, 22%, depends on how much they hold, but chances are that they will sell. Nothing wrong. Anybody who has a lot of shares at a very high PE will sell, whether it is you or the MNC parent, right? So they might sell, and if they sell before you sell, chances are the PE will correct, right? So when the PE is too high, you can be sure that one day the price will fall, unless you're seeing some sensational growth happening in that field or something like that. Then it could be a different case, but you have to be very careful. So this is a time to be careful. It is a time to switch either asset class or quality of asset. Both of this you can do. There is only one thing that in the short run you may look foolish. Over the next 3 months, 6 months you may look foolish, but in the long run you may look smart. The other reason to sell is because your goal is not very far away. Your goal is maybe 2, 3, 4 years away, and you're not sure whether this can sustain. So let's say your goal is 3 years away and you need 50 lakhs. Taking 1 lakh every month out of your portfolio is not a bad idea at all, which means over the next 36 months you would have taken out 36 lakhs, and that time you could go and take out a lump sum, or take a lump sum out, maybe 15 lakhs, you take it and put it into a debt fund. Right, you don't need to go for a very long-term debt fund. You are okay going even for a 10-year debt fund. You don't need to go for a 30-year duration debt fund. Go for a 10-year duration debt fund, because the 10-year duration and 30-year duration, the gap is not too much, and you are going to hold it for 3 years. If you were to hold it for 30 years, I would still say go for a 30-year gilt fund and not for the 10-year, because the switch is not worthwhile. So if you're getting 6.85 today on the 10-year and you're getting a 7 on the gilt at the 30-year, that 15 paise difference is not worthwhile for the person who is going to hold it for 2-3 years. Yes, that gap will widen, but you will not get the full benefit of the widening of the gap. So don't bother too much. So be in a 10-year fund, and after 3 years or maybe after 2 years, if interest rates have fallen, take that out and put it into a ultra short bond fund. And in the meanwhile, withdraw 1.25 lakhs per month from your diversified equity fund. Some you withdraw from your mid cap, some from small cap, and some from your large cap fund, right? So this is a way, these are the things that you should be doing now with your portfolio. Yes, you will look foolish in the short run, but you will look smart in the long run. Will you look foolish in 3 months? Will you look foolish in 6 months? Answer is yes, you could. Can the market keep going up like this for another 3 years? Yes, maybe. But you are not here in a race to see who is getting the best returns. You are in a race to see how you are able to meet your goals nicely, peacefully, and without sleepless nights. That if you can achieve, you have done a better job than a fund manager. Thank you.